In this short Bennett Explains video, I want to look at why the oil price is so volatile. Huge topic, short video, usual email address for further questions at the end. So, is the oil price volatile? Oh yes it is. It's in very recent years, this is just a snapshot of recent years, the Brent crude price in dollars has been all the way up to heady heights over $140 per barrel from more like 60 or so, and now as I make this video it's down, right down nearer to the sort of 45 mark and drifting south. So certainly is volatile over a relatively short time scale, and the wobbliness of this line just tells you that this is an asset that is pretty sensitive to events. So why is the oil price so volatile? Now the question I'm not going to answer is where next, and that's because I'm honest enough to say nobody really knows. I mean, just a few years ago there were analysts at big banks saying the price could hit $200 per barrel. Now the doomsters are saying it could go to well below 40 and stay there. But the truth is, nobody, and that may include some of the biggest producers on the planet, really knows. Why not? Because this is one heck of a complex market. Okay, the main culprits for the price volatility, and I'll run through them briefly, are complex supply and demand forces. I'll explain some of those in just a moment. Heavy speculation, so only a relatively small proportion of the contracts that involve, say, Brent crude oil actually result in delivery of any Brent crude oil. There's an awful lot of speculation going on in this market, and that drives prices. And political sensitivity, and I'll explain what I mean at the end. Oil is very sensitive to current events and politics. So, with no more ado, a complex market. Well, it's complex for a number of perspectives. First of all, there is no such thing as oil, the product. There are many different types, or many different cuts, as you can sometimes call them. Brent crude is the one that is most widely used and referenced in the market globally, but it's only one type of oil. If you want to see it that way, there's Dubai, Oman, that's used as a reference in the Middle East, as you might expect. Then there's West Texas Intermediate, the main benchmark in the US, and so on. So there isn't just one product. What's more, supply is very fragmented. When you say who supplies oil, well, it all depends who you aim the question at. So you've got government-owned national oil companies that operate as a direct extension of the governments in question. Some examples I've given here: Saudi Aramco, Pemex, and the China National Petroleum Corporation. So that's sort of government-sponsored, government-run oil producers. Then you've got the international oil companies, a few names you might recognise there: ExxonMobil, Royal Dutch Shell and BP, who actually make up a relatively small part of the market despite the fact they appear in the press quite a lot. And then, Tony Blair third way-like, you've got NOCs, national oil companies with strategic autonomy. So you've got something that's somewhere between the two, because you've got companies that combine state and corporate goals, so sort of independent of the government and sort of not. Big examples, Petrobras and Statoil. So what this tells you is you've got a whole different range of suppliers, and you've got different motivations potentially behind production and production targets. And just to summarise that graphically, you can see how fragmented world oil production actually is from there. Saudi Aramco alone accounted in 2012 for around 12% of world oil production, and some of those NOCs, nationally owned companies, as I mentioned, a substantial proportion of the rest. And then squeezed in this sort of corner here, you've got the companies that make the news quite often for good and bad reasons: the BPs, the Royal Dutch Shells, and the Exxons, and so on. So you can see you've got a very complex supply picture. What's more, this is a capital-intensive product. It takes a lot of time and a lot of money and a lot of effort and a lot of risk to get it out of the ground, transport it and refine it. And just to really summarise an awful lot of stuff in a couple of points here, upstream, as it's called, the so-called jargon, is exploration and production. That's the high risk, high capital intensity end of things. And that's costly, as I mentioned before, and time consuming. Stage two, the midstream, and there are risks all the way along this process, both political and economic sometimes, is the processing and transportation. And then the downstream, as it's known, is refining and marketing into stuff you can actually use, because you're not going to stick this stuff straight into your car. All right, so refining and marketing for petrol, diesel, heating oil, jet fuel, lubricants and petrochemicals, which are the main things that are generated from raw, if you want to put it that way, oil. So it's a long and complex process, and that has a knock-on effect for price volatility, which I'll come back to in a moment. Now, just a real snapshot, supply and demand drive the price of any assets ultimately, but the supply picture is complicated with oil. Why? And this is very much a snapshot of a lot of stuff that's going on at the moment. US oil stocks are high after the shale boost. So the US has effectively uncovered a new way to produce oil that's proved surprisingly successful. And what's more, what people thought was as the price came down, a lot of those people would stop doing it because they need a minimum price in order to make it cost effective. But actually, as one producer put it, we can't control commodity prices, but we can control the efficiency of our wells. So actually, more of those producers have stayed in business so far than a lot of people possibly expected or forecast. So that's meant there's more US supply on the market than perhaps some people anticipated. What's more, Russia isn't cutting production. Russia is a heavy exporter of oil, and although of course a fall in the price cuts the revenue they get from oil, they're still pumping the stuff out because their economy is so oil dependent, oil revenue dependent. OPEC has maintained production. Some people thought that they wouldn't, and there are various conspiracy theories around, by maintaining production instead of reining it in. As the price started falling, what are they trying to do? Maybe bankrupt the shale oil producers in the US. That's one theory doing the rounds. Put Iran out of business. There's another theory doing the rounds. Who knows? But the fact is, OPEC has maintained production at what some people see as a surprisingly high level, given prices falling. Iraqi production is at an all-time high, and sanctions against Iran may well be lifted fairly shortly, which would open the floodgates there. So to put it bluntly, there's a lot of supply around at the moment on the world scene, perhaps more than a lot of people foresaw. Now, combine that on the demand side with lower US imports, thanks to the stuff they're kind of home producing, if you like. US big on home security and being able to make stuff at home or produce it at home. Shale oil is a classic example. So there's a little bit less demand there. Slowing growth in China is pulling demand right down for commodities across the board, including oil, but copper and all sorts of other things as well. You've got slowing growth in Brazil, just to add to it. There's another one of the BRIC countries that is quite an important consumer of a whole range of commodities. And you've got a mixed outlook in the UK and Europe. Now throw another couple of things into the mix, which is environmental policies, trying to push people away from using substances like oil, for example, and the fact oil is priced in dollars, which means that as the dollar rises, oil gets more expensive for people who've got to pay for it in dollars, and you've got a picture that adds up to sliding demand with rising or strongly rising supply. So any wonder that the price has dropped quite dramatically from where it was just a little while ago. Now, next point to make is the role of speculation. So that's supply-demand forces. And the role of speculation is basically this. Speculators have a huge impact on where the oil price goes. I'm just going to summarize how that works in a nutshell. So this isn't speculation. This is just a very simple contract, and I've dumbed it down a bit for the purposes of this video. I agree to sell you 1,000 barrels of oil at $50 each in 3 months' time. Great. A very simple contract would say, fine, in 3 months' time, $50,000 comes that way, and the oil goes that way. Why would you sign that deal in the first place? Well, each person in my little trade here wants to lock in a price. On the left, a selling price. On the right, a buying price. And obviously the price could move over that 3-month period, but the point is, by locking in the price, you've kind of both hedged your exposure to a change in the oil price. So far, where's the speculation? Well, there's a little bit of speculation in there, you might say, but pure speculation is this. It's where there's actually no delivery of oil for a similar contract. So what I mean by that is the contract might start off the same. I agree to sell you 1,000 barrels of oil at $50 each in 3 months' time. The price falls during that 3-month period to just $45 a barrel. So it's $5 per barrel down, okay? Basically, on the right-hand side, you wouldn't be too happy at this point because you'd be thinking, well, I've committed to buy 1,000 barrels at $50 each. I can already get them cheaper on the open market, and the contract's not even run its course yet. So I really wish I hadn't signed it. Well, there's a chance, if you think about it, and I'm playing around with the facts, simplifying a bit, there's a chance the guy over here might think, do you know what? I'll keep the oil, I'll let you out of the contract, but it's going to cost you $5,000. Why? Because basically I know that at the end of the day, the oil I could sell to you at $50 is now only worth $45 a barrel. So to let you out of the contract, I've got to charge you the difference so that I'm kind of at break even again. Okay? Take that a step further and introduce the idea that one or either party to the contract might run away without either delivering the oil or paying for it, and you get closer to how the futures market works. So here's pure speculation with initial margin, as I put it. Same contract at the beginning, I'll sell you 1,000 barrels of oil for $50 each in 3 months' time. Both parties put a $500 deposit down, in practice at a clearing organisation, but we'll leave that to one side. The price falls to $45 a barrel, as it did the first time around, and here's the deal. Effectively now, to get out of the contract, it's going to cost the original $500 deposit, which is lost. That's a kind of security deposit just to make sure that neither party bails on the deal before 3 months is up, plus another $4,500 making up the total $5,000 profit on the left-hand side. And the point being that if both parties agree to close out the original contract prior to the point where delivery of oil has to take place, no delivery of oil actually does take place. Guy on the left keeps the oil, even assuming they had it in the first place, of course, and makes a $5,000 profit in the process, which is roughly 10 times their initial $500 deposit, which is what they needed to get onto the table, if I can put it that way. Now, summarise a lot of facts there, but the point I'm trying to get to is that the majority of contracts that actually involve oil that are traded globally never result in any oil going from anyone to anyone else. All right? And that has a big part to play in the volatility of prices in the oil market. That speculative activity, as I've just illustrated there, using admittedly very simple terms. Now, finally, politics. Oil is incredibly sensitive to geopolitical events because it's such an important commodity. So I've just listed a few here. I'm not saying these are the only cause of what happened to the oil price, but they certainly played a part. Low spare capacity can drive the price up once word gets out. A big financial crisis can have the opposite effect, as it did back then. This is the original graph. OPEC then cut its targets in response, its production targets, which a lot of people thought had that effect on the price. China slowing is one of the big factors I mentioned that started to push the price south as demand slows or disappears. Volatility is therefore built in to the oil price. Basically, it's a fact of life. Supply and demand are relatively unresponsive to price as a result of what I've just been through. Oil production capacity can't increase or decrease fast. Oil consumers can't quickly change their behaviour or switch products. And that inelasticity means that any shock to the system can create big price changes. So there you have it. You've got a complex supply and demand picture, a market dominated almost by speculative forces and high sensitivity to geopolitical events. In a nutshell, that is why the oil price is so volatile. Any questions to the usual place?